On Friday, the stock market crashed $1 trillion in a single day, and everyone is panicked about the Dow dropping nearly 800 points. The media is telling you that this is just a temporary geopolitical dip and the Fed is going to step in with rate cuts to save your portfolio, which is allegedly a complete lie. The market is finally waking up to the fact that nobody is coming to save it. My name's Nick. I've been a professional investor and unprofessional trader for 24 years. Today we need to talk about the three forces that just broke the global economy and what is actually coming next. Let's figure this out together. But before we start, I'm not a financial advisor. This is not an inducement to buy or sell any assets. And most importantly, do not take financial advice from some random dude on YouTube. So let's get straight into it. If you turn on financial news right now, you'll hear a very comforting bedtime story. They're going to tell you that the S&P 500 is shedding trillions of dollars, but it's just a healthy pullback. Don't worry, buy the dip. They said the US-Iran war is just a short-term shock, so retail traders are doing what they always do. They are listening and buying the dip. They are loading up on tech stocks and assuming that the Federal Reserve will swoop in with rate cuts by summer. But the catch is the smart money is already running for the exits, allegedly, and they are using retail liquidity to unload their bags. The institutional vultures know exactly what is happening under the hood. We're being hit by three massive economic forces all at the exact same time, and it's creating a stagflationary nightmare that the Fed cannot fix. Let's look at the actual data. Force number one is oil. West Texas Intermediate just blasted past $90 a barrel. US crude just recorded its biggest weekly gain since the futures contract was even created in 1983. Why? Because the Strait of Hormuz is essentially closed. Crude tanker traffic through the strait has plunged by 88%. This is where a fifth of the world's oil flows. The media calls this a temporary disruption, but Qatar and Iraq are already shutting down production. That is a structural supply shock. Force number two is the death of the American jobs market. February non-farm payrolls didn't just miss expectations, they were negative. The US economy lost 92,000 jobs last month. That is catastrophic. And unemployment ticked up to 4.4%. But here's the absolute worst part of everything. Wages are still rising by nearly 4% year over year. Now, wages rising, that sounds good, right? It sounds good on the surface, but it's actually very bad when paired with everything else that's going on. Higher wages lead to inflation. So you have skyrocketing energy costs pushing up inflation, higher wages pushing up inflation, while the labor market bleeds out. That is the textbook definition of stagflation. We haven't seen this specific toxic combination since the 1970s, which brings us to force number three. The Federal Reserve is completely paralyzed right now. At the start of the year, Wall Street promised you 3 rate cuts. Now swaps markets are pricing in a 97% chance the Fed does absolutely nothing in their next meeting. Bond traders are panicking right now. The 10-year Treasury yield just surged past 4.17%. The VIX, which is Wall Street's fear gauge, essentially, the VIX tracks fear on Wall Street. It just spiked nearly 30% in a single session, and the Atlanta Fed just slashed their Q1 GDP estimate down to 2.1%, which honestly, I think it's probably going to go lower than that. Think about the trap that the Fed is in right now. They only have one fire extinguisher. If they cut rates to stop bleeding in the jobs market, they pour gasoline on the inflation fire caused by $90 oil, right, per barrel. If they hold rates high to fight inflation, they push economy into a deep recession. They're completely trapped. And who pays the price for this? Well, as always, you do. We do. Corporate margins are getting squeezed from both sides. Oil at 90 means that input costs and shipping costs are rising for every single company on earth. Normally, they would just pass those costs on to the consumer, but it's not that easy to pass costs on to consumers who are losing their jobs and maxing out their credit cards. Retail sales already missed estimates in January. The consumer is tapped out. So earnings are going to collapse. And the big banks know this. It's not a coincidence that they're all of a sudden telling people, don't worry, buy the stock market dip. It's a healthy correction. JP Morgan published a note to clients saying that they expect a 1 to 2 week decline, creating a perfect buy the dip opportunity. Chief investment strategist at Standard Chartered said that the central case remains to buy the dip because they expect a short-lived 5 to 10% pullback rather than a regime change. Barclays advised waiting for roughly a 10% drop in the S&P 500 before stepping in to buy the dip. Then Oxford Economics told everyone, or told their clients, to buy European and Asian assets the second they fall. Why are banks all of a sudden telling us to buy the dip? I was here in 2008 when banks started yelling buy. It's because they were secretly selling, allegedly. But that's not financial advice anyway. I'm not registered to be a financial advisor, so I can't give you financial advice. Apparently you should take financial advice from the registered advisors, like the banks, right? Who have a history of manipulating retail. Anyway, whatever. If the war doesn't end, or at the very least the strait doesn't open, we could be in for a rough year this year. So fingers crossed it's over soon. What do you think?